A country's currency can collapse in 72 hours. Its entire economy can be destroyed without a single shot fired. Its citizens' savings can evaporate overnight, and the nation that attacks has broken no laws. This isn't hypothetical. It's happened repeatedly throughout history, and the weapon is more powerful than any military arsenal. Today, we're exploring the financial doomsday device that governments fear most and citizens don't understand. Welcome to Money Stories, where we uncover the hidden histories of finance and expose the economic weapons that reshape nations. Today, we're examining currency attacks, the most devastating economic weapon ever created, and why no country can truly defend against them. In 1997, Thailand experienced something most economists thought impossible in the modern world. The Thai baht, the nation's currency, collapsed. The value plummeted from roughly 25 baht per dollar to over 50 baht per dollar in a matter of weeks. This wasn't because Thailand's economy fundamentally changed overnight. It wasn't because the country was invaded or suffered a natural disaster. It was because speculators decided the baht was overvalued and collectively bet against it. When enough money fled the currency, the Thai government couldn't defend it. Thailand's foreign exchange reserves were depleted, trying to prop up the currency. Eventually, Thailand capitulated, let the baht float, and it crashed. The collapse triggered a domino effect across Asia. Currency speculators realized that if one country's currency could be attacked successfully, others could too. The Malaysian ringgit came under attack next, then the Indonesian rupiah, then the South Korean won. Within months, the entire region was in crisis. Stock markets collapsed. Unemployment soared. Poverty increased dramatically. Millions of people who had been middle class were suddenly destitute. All of this was triggered not by any fundamental change in these nations' economies, but by coordinated currency speculation. The Thai crisis revealed a fundamental vulnerability in the modern financial system. Any nation that relies on international trade and maintains a freely convertible currency can be attacked through currency speculation. An investor, hedge fund, or coordinated group of speculators can bet against a nation's currency. If enough money flows out of the currency, the government must either defend the currency by spending foreign exchange reserves or allow it to collapse. If the government spends reserves defending the currency, it eventually runs out of ammunition. If it allows the currency to collapse, the entire economy collapses with it. George Soros became famous for executing one of history's most successful currency attacks. In 1992, Soros bet roughly $10 billion against the British pound. Soros believed the pound was overvalued and would eventually fall. He placed massive bets shorting the pound, purchasing puts on the pound, doing everything he could to profit if the pound declined. The British government, desperate to defend its currency, spent billions trying to prop up the pound, but eventually the government ran out of ammunition. The pound crashed. Soros made over $1 billion profit, and Britain suffered an economic crisis. What's remarkable about the Soros attack is that it was completely legal. Soros broke no laws. He simply made a bet that the British government couldn't afford to defend its currency. And he was right. The government had to accept defeat and let the currency fall. The British people suffered the consequences through inflation, reduced purchasing power, and economic contraction. But Soros faced no legal consequences. He had simply played the game of international finance better than the British government had. The mechanics of a currency attack are straightforward. An attacker needs three things: capital, information, and timing. The attacker needs massive capital, billions of dollars, to bet against a currency. The attacker needs information about which currencies are vulnerable, which typically means identifying nations with large current account deficits, declining foreign exchange reserves, or political instability. And the attacker needs to time the attack when the government is weakest or least prepared to defend. Once an attack begins, it becomes self-fulfilling. If speculators believe a currency will fall, they sell the currency. This selling pressure causes the currency to fall. The falling currency confirms the speculator's belief, attracting more sellers. Within days, the currency can be in free fall. The government's foreign exchange reserves are depleted, trying to defend, and eventually the government must capitulate. The currency collapses, and speculators who bet against it make enormous profits. The victims are ordinary citizens. When a currency collapses, the purchasing power of everyone holding that currency is devastated. Savings are wiped out. Incomes don't keep pace with inflation. Businesses that owe foreign currency debts face impossible repayment obligations. Unemployment soars as businesses fail. Poverty increases as the middle class is destroyed. All of this happens because speculators made bets that the government couldn't defend its currency. The 1997 Asian crisis affected roughly 250 million people. Millions fell into poverty. Suicide rates increased. The region took decades to recover, and the attack was completely legal. The speculators faced no consequences. They had simply recognized an economic vulnerability and exploited it. This is the defining feature of currency attacks. They're devastating but legal. Mexico experienced a currency attack in 1994. The Mexican peso collapsed from roughly 3 pesos per dollar to over 7 pesos pesos per dollar within months. The attack wiped out the Mexican middle class. Unemployment soared, poverty increased dramatically. The United States had to provide emergency financing to prevent complete collapse. But the speculators who attacked the peso faced no legal consequences. They had simply bet against a currency they correctly believed was vulnerable. Russia experienced a currency attack in 1998. The ruble collapsed. Savings were wiped out. The entire financial system nearly failed. People lost everything. Suicide rates increased. The economy contracted dramatically. Again, the speculators faced no legal consequences. Argentina experienced a currency attack in 2002. The peso collapsed. The government defaulted on its debt, and the economy contracted by roughly 28% in a single year. Millions of people were devastated. But again, the speculators who attacked the currency faced no legal consequences. The pattern is consistent. Identify a vulnerable currency, attack it, profit from its collapse, and face no legal consequences. The weapon is powerful, devastating, and completely legal under international law. Defending against currency attacks is extraordinarily difficult. A government can try to defend its currency by spending foreign exchange reserves to buy its own currency and support the price. But this only works if the government has sufficient reserves and if speculators believe the government will succeed. If speculators sense weakness if reserves are declining, if the government is losing confidence, the attack accelerates. A government can also implement capital controls, restricting the ability of money to flow out of the country. But capital controls are economically destructive. They discourage foreign investment, they reduce economic efficiency, and they typically fail if the pressure is sustained. Malaysia tried capital controls during the 1997 Asian crisis, and they were only partially effective. A government can raise interest rates to make holding the currency more attractive, but high interest rates destroy the real economy by making borrowing expensive and reducing investment. This creates a dilemma. Defend the currency by destroying the economy, or accept currency collapse. The most effective defense is actually prevention. A nation can defend itself against currency attacks by maintaining large foreign exchange reserves, maintaining a current account surplus, avoiding excessive foreign currency, debt, and maintaining political stability. These measures reduce vulnerability but can't eliminate it entirely. China, Russia, and other nations have been building alternatives to reduce their vulnerability to currency attacks. China has been accumulating gold and developing the petroyuan specifically to reduce dependence on the dollar. Russia has been building gold reserves and reducing foreign currency debt. These steps reduce but don't eliminate vulnerability. The United States benefits from currency attacks because the dollar is the world's reserve currency. Most currency attacks are against other nations' currencies, not the dollar. If speculators attack the Thai baht or the Brazilian real or the Mexican peso, that creates demand for dollars as investors flee into safety. The dollar strengthens when other currencies are attacked. This means the United States profits from instability in the international financial system. This gives the United States an incentive to tolerate currency speculation and currency attacks. The U.S. benefits from the chaos. American financial firms profit from currency speculation. American investors profit from betting against vulnerable currencies. The U.S. government doesn't restrict currency speculation because it benefits the U.S. economy and American investors. But this creates a moral hazard. If the United States benefits from currency attacks, it has incentives to tolerate or even encourage them. Currency attacks are weapons of the strong against the weak. They devastate ordinary people in developing nations, yet they're completely legal because the international financial system benefits powerful nations that allow them. The question becomes, is this system just? Should speculators be able to destroy nations' economies and devastate millions of lives for profit? Should currency attacks be legal, or should the international community ban them as weapons of economic destruction? These are fundamentally moral and political questions, not economic ones. That's the story of currency. Attacks the financial weapon that can collapse a country in 72 hours and is completely legal. If you found this exploration of economic weapons fascinating, subscribe to Money Stories for more uncovered truths about the systems that control our world. Leave a comment below. Do you think currency speculation should be restricted to prevent attacks on vulnerable nations? Or is it a legitimate part of free markets? Thanks for watching Money Stories, and I'll see you in the next episode.